A little bit about the INCA Investments and an overview about our organization. And we have approximately $600 million in assets under management. We are an independently owned firm. We're 100% owned by the employees. The two other owners in the organization, principals, are Efrain Chavez, who is our portfolio manager, and also David Borenstein, who is in charge of operations. We have 11 employees. We have a nice picture of a good-looking team here. When this is a relatively new picture, and when we had it taken, Fabiana told me that, hey, you don't even have to stand together now for the group picture. They kind of put it together, and you don't have to be a fashion model to have a little bit of Photoshop. You need some help. So when I saw that, I asked her if they were going to be able to maybe Photoshop me, help me make a little younger, take off a few pounds. He goes, no, that's the Photoshop version already. So that was a little bit of a gut check, but we have 6 people on the investment team. We have 5 on the back office, which we call the quality team at INCA Investments, and 8 of them which have lived in Latin America. Now, there's a few people who would claim that since we all now live in Miami, that those 8 have never left Latin America, and there's certainly some truth to that. And as I mentioned, we are based in Miami, and you should know that certainly I'm Peruvian, so I lived in Peru for a while when I was at a firm, LatinVest, which later became GlobalVest, was the director of research, had a team. My part of the investment team was in Brazil. So I worked with a group over there, and then and I lived, when I was in Zephyr Management, I lived in Mexico for about 6 years. So I'm certainly familiar with living in the region. And I was actually living in Mexico City in 2004 when I found INCA Investments. And so we had the choice to kind of place it wherever we needed to. It was a one-man shop, so it was kind of easy decision to make for myself. And I really felt that Miami was the best place to be located. One, it avoids single country bias, and I think that's important for what we do. We are regional investors. You tend to get more information and sometimes bias your investment decisions in the country that you're in, and a lot of the times that information tends to be noise. And we are long-term investment decision makers, so the noise is something that we kind of are glad that we avoid. Miami has excellent travel logistics to Latin America. Many people refer to it as the business capital of Latin America. And the other thing about us is that we value the staff diversity that we could find at the organization. I think that helps. Part of what creates our organization is that Latin America permeates our organization, and we put a lot of value on that and the variety of experiences that come to the table from that. I'm going to talk about our investment process. We are value investors. To us, that means that we believe that investors tend to take whatever trend there is and kind of continue valuing that trend going forward. So when something is looking favorable, they tend to continue thinking that trend's going to continue. And when something's not looking so well on the negative side, they tend to discount that, and at times overly discounted. That's the place where we try to find some value to invest in. The way we do that is we try to find overly discounted companies that may be for a variety of factors. One of them could be a country factor. A country may be undergoing a tough economic period. The obvious country that falls in that category right now, Brazil. And that is that it is going certainly through a difficult scenario. And we'll talk a little bit about how we try to see beyond that scenario, or how we deal with that environment. An industry factor could be something like steel. Steel is certainly an industry that's been out of favor for quite some time. We have one investment in a steel company. We think the negative trend in steel companies has given us the ability to buy what we think is an excellent company, which has done very well for us. So that's an example of how we may find a bargain in a particular out of sector that's out of favor. A company could be any particular company that has something individual to it. Cemex could be an example. Cemex had a very strong performance leading up to the Great Recession. The construction boom obviously helped it. And then when that turned around, what we saw is that all of a sudden this company was greatly out of favor. Investors continue to look at Cemex going forward when they had made some decisions to really change their model, in particular about debt and acquisitions, and kind of tended to price that going forward. And we said, well, it's a different company now, and we think that there's an opportunity for it to actually be priced differently as investors finally understand that the Cemex model of the past. It's not the Cemex that's going to be going forward. And we try to find these kind of bets on what we would consider to be fundamental analysis and in franchise companies. And what I mean by that are companies that are top tier companies. We are not traditional Graham investors of cigar butt companies that a really cheap company merits being invested in. We believe that to find these franchise companies, which we like, that we have to really know them very well and believe that they have a good long-term future. So let me talk about our value philosophy and how we invest using this value philosophy. And so we want to find these contrarian investment opportunities throughout the universe, but there's certainly certain places that we have learned over time that seem to be maybe pockets of them. One of them would be in the mid and small cap stocks, where there tends to be a little bit more inefficiencies. And the other one would be non-index countries. So for example, we have an investment in Panama we do now. We used to in Argentina. We don't have currently any investments in Argentina. But countries that are out of the index, kind of out of the mainstream, have a greater chance to find a contrarian franchise company that we would like. We invest with a very long-term time frame. This increases the likelihood that whatever negative event that the market is discounting, it gives a greater chance for it to dissipate. And the word dissipate is important here because a lot of times it's not that something great comes back that makes investors forget about this negative event. A lot of times it's just over time they start focusing on that negative event, and that allows the share price to go up. Buying bargain companies or companies that are cheaply valued or have cheap prices also allows you to have longer holding periods. By that, what we mean is that a company can have a 50%, maybe double in its price and still be a company that we are interested in holding because it hasn't hit a valuation metric that we think makes it too expensive. And longer holding periods are very important to us. One, because it minimizes our decision making. These are not easy decisions to make. They're not easy opportunities to find. So the less decisions we have to make, that works the better for us. And it also reduces portfolio turnover, which we like. It certainly minimizes cost. If you think about portfolio turnover, Morningstar says that a typical Latin America fund, now this would be retail funds, will have a turnover about 150% per year. Our turnover last year, because we had a very negative drop in the Latin American markets of 31%, went up. It was near 70%. Previous to those, to last year, it averaged about 33% for the last 3 years. That was a more normalized period. Our turnover will go up when we think there's a lot more volatility in the prices. And so we think that going forward, I think this year it'll get much closer to our historical average of 33%, meaning that's a 3-year time frame. We construct a portfolio of 15 to 20 companies that we believe have asymmetrical risk. And that means we think there's more chance for the upside to happen than the downside of the equation. We don't get everyone right, but that's the whole purpose of portfolio management, getting a group of them that you think overall the majority of them are going to behave the way you think they're going to. This is our investment process. Some of you are very familiar with it. What I'd like to do is just kind of take that and break it down into the different decisional factors that we base and explain to you how our process works. The first part of it is ideas. How do you generate your ideas? The first, what we do is quantitative screening. You weed out companies with insufficient liquidity. For us, generally speaking, that's about $2.5 million or so of average daily trading volume. If you take the entire universe of Latin America, it's about 1,000 companies. You weed it out for this parameter I just gave you, and then you're going to get down to about 250 companies. And so we do that, and we're looking for those companies that have gone down afterwards. Out of those companies, the ones that have gone down the most, or those that have particularly low valuation metrics. And so then we take those companies and we have to decide which are the ones we're interested in, and this is what we call the qualitative screening. we want to make sure, as I mentioned, that these are franchise companies. We're just not looking for companies that have been beat up and have low valuation. We want them to be very good long-term enterprises with good business models. Many cases, they're either going to be the very top dominant company, maybe they'll be the second one, but they have to be very strong. And this is where I think the experience really comes in of our team. The quantitative screening, anyone can buy a database and do the same screening that we do. The difference is in the qualitative side of the equation. In other words, 60 years plus of experience of our investment team, that's when we can start saying, hey, very quickly, this is a company that's going to get our attention. It's either gone down, it has the valuation metrics we're looking for, but yet it's a company that we like and we understand and we believe it has a good long-term future ahead of it. And that's very important because this quicker we can do that, the quicker we can focus in on those companies that we should be spending our time on. Next part of the investment process is the analysis part, which we kind of have an investment toolbox. What that means, there's no cookie cutter approach to any particular company. We certainly do certain processes for every company. The first one is normalization of financial statements. We're dealing with at least 5 countries, maybe 6 or 7 countries at any one time. And we need to figure out a way to go and, for that company, get rid of those items in the accounting statements that we think are giving us some sort of information that we don't think is particularly reflective of the company as a business. What that means is that the depreciation may be higher in one country than another. There's inflation accounting, there's currency accounting, and we have to take those things out of the equation and get a normalized net income, because that normalized net income is what allows us to get good pricing. Now we know what the pricing is of that company, and we can begin doing the rest of our work based on the valuation that pricing is giving us. We do valuation models. It's a very standard step for almost anyone of our industry, and we certainly do it where we take what we think is either going to be, depending on the company, we may be focused on net income, we may be focused on cash flow, we don't focus on EBITDA, we may look at it, it's a valuation, but that's kind of only looking at maybe 2/3 of the company. We want to take it all the way down to the net income line. And it helps us ensure that this franchise model that we're interested is in play here, that it has the sort of metrics that we expect to see from a valuation company, from the companies we invest in. And the other part of the equation that's important here is valuation models. These traditional valuation models do make you focus on the details. And so we certainly, that's something that we value, is being forced, the analysts being forced as they're creating these models to think through how operations are going through the statements on an annual basis, how the gross margins are expanding, how working capital is working. Valuation models enforce that discipline on you. We do industry comparison, so we're looking at the target companies that have gotten our attention, and we're comparing them with other Latin American companies, and we're also comparing them with global companies. So not only are we going to compare them on valuation metrics, we're also, such as PE and dividend yields, price to book, firm value to sales. Those are important to us, but also maybe operational metrics. So for a cement company, we'd like to know how much we're paying per ton of capacity. For a steel company, we would do something similar. We there also have something that we call upside analysis. And upside analysis is what we would call more of a blunt instrument. And why do I say that? Because upside analysis, we may look at 3 years or 5 years and we say, what's going to, in 3 years, what would we expect the earnings of this company to be? And what would be a rational valuation to put on that company? And it gives us an idea how much potential there is for upside. Now, this is a particularly handy tool when you're dealing with the country in a crisis environment. So in other words, it's really impossible, at least for us, to have said in 2016, this is going to be the earnings of a Brazilian company, or in 2017 what it's going to be. That's very difficult, if not totally unpredictable to do. But what we can do, and what we did, is we can say, what do we think in 5 years? In the year 2020, when we expected Brazil to be in a normalized environment, not a great growth environment, just a normalized environment, what could we expect the earnings of a Brazilian company to be, and what could we expect the valuation of that company to be. And you're going to see a little bit of this when we talk about a Brazilian company that's in the portfolio. Decision making. So we have to try to understand why this company is being discounted. And so we have to understand that, and then we have to understand why would we be willing to challenge that market or consensus view. And that becomes our thesis. And so that is, we have to understand, this is how we think the value will come to fruition, which generally means that negative event either has to go away or investors have to be less concerned about it in the future. But that's a very important part of how this is how we track of what we're actually doing. The way it works is we meet on a weekly basis, and an analyst who's tracking a company and presenting it to us is doing it on a week-to-week basis. And they're going to get feedback from the rest of the team as to what they should be focusing on, or maybe this is a company that's going to be a non-starter and really not going to make it to the portfolio. If that's the case, they're going to drop it. If not, they're going to continue presenting it, and we're going to bring up more questions or challenges. Eventually, if the analyst feels comfortable, they're going to say that they'd like to make a presentation for that company to go into the portfolio. When they do that, we assign a devil's advocate. A devil's advocate's job is to kind of be a professional heckler on that company and decide all the reasons of why we shouldn't invest in that company. That person's going to roll up their sleeves and really look at all the details, the fundamental work that the analyst has done on it, and challenge those assumptions. It wouldn't be efficient for all of us to do that, but it is sufficient for us to assign one person, the devil's advocate, to take on the specifics of that thesis. Then the analyst presents the investment case for the portfolio and presents it. Generally speaking, we can feel that there's a consensus there. And again, remember, this company has been vetted for quite some time before it goes into our portfolio. And we reach an investment conclusion. We generally don't have to take a vote, but if we did take a vote, my vote as the CIO or Efrain's vote as the portfolio manager is the same as the analyst vote. And why? Because our process is meant to try to maximize the consensus, the overall, the experience that we bring to the table. And so when certainly I'm going to have certain views because I've been doing this since 1990, have a certain experience, and maybe have certain biases. And but that's what, as the Chief Investment Officer, I don't have any industry assigned to me. I'm the only one on the team without an industry assigned, but my vote doesn't count more than anyone else's vote. And Efrain is a portfolio manager in our organization. What it means that he's really in charge of managing the investment process, making sure that what the assignments are and making sure that the analysts are following through on the companies and what we've asked them to review. But at the end of the day, when we make a decision, it's going to be based on a consensus. And the last part where we talk about joint responsibility, that's very important. Once a decision is made by the team, even though it's been led by analysts, it becomes a team decision. And that's very important because when you think about what we're trying to ask analysts to do, we're asking them to take on the consensus. That's not an easy thing to do. The easy thing to do is go in with the consensus and have the safety of the herd with you. And that's not what we want to encourage. We're asking people to take on the consensus. So we don't want to do finger pointing, because if we do finger pointing when things go wrong, what we're teaching people is take the safety route of getting into the herd. And we don't want to do that. So it's very important that once a decision is made by the team, it becomes our decision. If something goes wrong, that's fine. We don't point fingers, but what we do is we try to understand as a team where we went wrong. Once or as the decision is being made, obviously these factors are important, and one of them is risk management. We think of risk management a little bit differently than most people. We don't think about, 10%, the stock goes down in 10%, which can be a daily event, a one-day event in Latin America, that we should sell out the position. That's not how we think. Indeed, our nature is when price goes down against us, it is to buy more of it as long as we think the fundamentals haven't changed. We want to avoid too many what we call single factor risk. What would be single factor risk when you're dealing with Latin American companies? It would be commodity prices. It would be the strength of the US dollar. It would be global interest rates, things like that. We want to make sure that the portfolio is not too embedded into one of those risk factors. we, over time, once it's in the portfolio, we need to make sure, obviously, that we're monitoring this investment risk. And so that means whenever we get points of information, which are generally when you have quarterly reports, but not always, sometimes you get them in between, but quarterly reports give us a lot of information. So obviously the analyst is going to focus on that, but what they're not going to do is they're not going to focus if they got 4 cents per share as opposed to 5 cents per share. That's not what we do. What we do is we've made an investment thesis, and now we want to make sure that the investment thesis is being met. Are we on a long-term trend? Is the quarterly information supporting what we expect to happen in the long-term trend? That's the way we look at quarterly reports and the information that they provide. What's our self-discipline? We, in an ideal world, we'd like to have what's called a push sell. A push sell means there's a company that we now want to add to the portfolio that is so attractive that it's going to push something else out. But there's also what we call a pull sell, and that is sometimes our thesis is not working out, then it's time to just pull it out of the portfolio. So that happens too. I'm going to now give you a brief update on what's been going on with Latin America and how kind of our process has worked to shift, how to result in the decisions that we've made. And so for people that were here in October of 2014, we spoke about what was going on in the current environment back then. And this is in a nutshell of what we are seeing. And that is that overall, in Latin America, the growth was okay, economically speaking. And so you see here, and we've separated Brazil, and you'll see why a little bit later, but you can see that for the 5 years between 2010 and 2014, Latin America was doing okay, in spite of kind of being a tough environment because commodity prices had begun to go down. And so you can see that things were okay economically. But if you look at this 5-year market return, you'll see that Brazil went down 40%. A lot of this was the currency, and we talk about here that this currency went down 34%. So the majority of it was currency. Again, currency is important because currency is driven by the global markets. Currencies are the biggest markets in the world. And a lot of times, the people making these global decisions know a couple of things about Latin America, but they're certainly not focused. Latin America is still a relatively small part of the world economy. And so there's a lot of people making these big macro long-term decisions on what we would call very simplistic information about Latin America. So the Brazil real, we're not saying that it didn't deserve to go down that much. We're just saying there are very simple decisions being made to bring the real down at that time. And so the 5-year market return, even though the rest of these markets are doing okay, obviously Chile was not, the market went down about 24% in 2014. Now, what we were talking about back then was, number one, we didn't think commodity prices were as big a factor as people thought they were, especially the global traders. And the reason we said that is because if you look at the way commodity prices or commodity, the importance of it to Latin America is, it's not as high as people think. So what we have here, the World Bank put something that they call natural resource rents as a percentage of GDP. So in that sense, the profitability and how important it is to your economy. Up here, if you look at the top countries, you'll see that for some countries, they are the driver. These are what we call maybe the one-trick pony economies of the world, where really, and namely, we're talking about oil here, right? Is going to really depend how economically these particular countries are going to do. Then we have the Latin American countries here, and they're certainly above average. If you took the weighted average of that, it's like 9%. And so 3.9% is the world average. So you can certainly see that Latin America is above average. But what Latin America is not driven by commodity prices. We said they're an important factor, but they're not the driver. And the reason is Latin America is not an export part of the world. If you look at exports as a percentage of GDP in Latin America, it's 20%. So if 20% is making up of your economy is equal to the GDP, then what's the remaining part of it? That's the domestic economy. And that's what is the driver for Latin America. So he said, Latin America, we think people overgeneralize the importance of commodities to that part of the world.
Question on that.
Yes.
Much more important to like government revenues countries.
Absolutely. Absolutely. So if you look at Colombia, in particular Mexico, it's very important. So for Mexico, it's actually about 29% of the fiscal deficit, and that's why you see that it has affected Mexico. And what we would say is, yes, it's a negative factor, but it's not the driver. So government spending goes down, but government spending is only 8%, 18% of the Mexican economy. So you do have a factor, and that's what creates the slowdown that we're talking about. So our point here would be that these economies are being negatively affected. The growth rates are not 4 and 5%. They're down. You can see them starting to come down, and they're going to continue to come down, actually. But what we're saying is it doesn't send your country into a crisis because commodity prices go down. So, and so what we're seeing, and that line is 2014. And so here's commodity prices. Here's the other thing we said. Not only is commodities not the only driver, it's an important factor, but guess what? Commodity prices have kind of come down already somewhat. And so that's the red line at the end of 2014. And you can see certainly for oil, it continued to go down. For oil, you can see it's starting to get very close to 2002 at that bottom right over there. Remember, that's before China really exerts itself into the world economy. And so it's at a very low point. And for other copper, which is, and you can see the percentage of GDP that's important there, and iron ore, which is particularly important to Brazil, and gold, which has kind of, you know, different supply-demand factors than traditional economies. And so what happened is in 2014, we said it's already gone down quite a bit, but it did continue to go down, and particularly for the price of oil. Again, we wouldn't know that because we don't have an ability to predict things, but we do look at trends sometimes and say, hey, where are the probabilities? And what we wanted to do is just avoid some sort of buying at the top scenario of the commodity price equation. And so what happens? So let me see. So in 2015 here, you will see this is the growth. So here's the point. So the commodity prices continue to go down. And look at the growth of these four countries. It's not great. Again, 2.7% is not good enough for a developing economy for it to grow. But look at Brazil. It's Brazil that goes down. Now remember, Brazil here is the lowest commodity country, if you will, and it's the one that went down the most. So why did it go down so much, economy? Not because commodities, not because the price of iron ore, but because they didn't manage their economy well. They went into 10% deficits, and that's largely because they had an election in October 2014, and they turned on the fiscal pump in a big way to try to win those elections. And so this is Brazil going down as an economy, again, not because of commodities, but because they didn't manage their domestic economy well. This is the Latin American. That's a simple average. We couldn't get the factors to give you weighted averages, but for this one we could. The weighted average would be slightly negative, about negative 0.6%, if you take into account that Brazil is about 56% of the index. And so, but what you can see here is, so you have this situation, but look at what happens to the market. The market goes down 31%. That's a huge amount in 2015. That includes a currency decline of 24.4%. So about 86% of the decline was due to the currency side of the equation. Again, who runs currencies? Global traders do, and we think they make short-term, simple bets. And so this is the result of what happened in 2015. And I want to tell you a little bit of how our process and how we were thinking. And so what did we do in 2015? And what we do in 2015 is not that different than what we do in previous years. It's not that much different than what we're doing now. And that is you sell the winners. So those companies that are doing relatively well, we're going to sell. So those were Argentine equities, Argentina was going through a favorable change in the administration towards the end, from a very populist administration over the last 10 years to someone who was very pro-market reform, and that is Macri. There were certain Brazilian companies that did very, very well. There was real dichotomy in some of the prices of the Brazilian stocks. And so there are certain ones, in particular someone like a BR Foods, which is largely an exporting country, is making its revenues in dollars. It actually did very well. So we sold the winners, and we increased our exposure to what the market at the time was calling the losers. Who would be the losers? And these are franchise companies. Localiza is the company that's going to present right after I speak. And this is a great world-class company franchise. And it went down tremendously. Companies like Credit Corp, which we would argue Latin American banks are incredibly strong, but the Peruvian bank is really, we think, top tier among those. And airline company Copa, Cemex, which is a company that had problems, but now was in a very different path. The path that we considered towards great improvement compared to its past. And so what we did is we invested into those companies that the market disliked at the time, and small cap equities. Now we were able to reach a little bit down further, and remember that the liquidity had gone down, as it always does in a crisis situation, and we took some of this by selling these bigger cap Brazilian companies. We were able to go into some smaller caps, and smaller caps in Latin America work the same way as they do around the world. In a negative scenario, they go down at a multiple of what the large cap ones would. So we saw particular potential there. Now we had to deal with one country, Brazil, which is certainly going to what you could consider a crisis environment, because not only were they now in a very negative situation, the leader at the time, the president, Dilma, was not espousing really any radical changes that they had to make for Brazil to get out of this 10% budget deficit that it was running. On top of that, the currencies had gone up so much that the real problem for Brazil was that industrial production was going down enormously. And so investors were very concerned about that. They didn't see how there was going to be a change, and they saw a continuation of this negative environment. And so what did we do? Well, we didn't know what was going to happen in next year. We certainly didn't know that Dilma was going to be impeached and that a pro-reform government was going to come in that has taken some very important steps. We didn't know that. But here's what we thought we could do. We said back in 2015, we said, how long does it take for the Brazilian economy to normalize? Again, that doesn't mean great growth. It just means to where it's in a normal scenario. And we said, is 3 years reasonable? Well, maybe, but where we feel comfortable is 5 years. In 2020, what happens by 2020? When you're going to have another election. We think if the economy is doing so bad, you have a really good chance of a pro-reformer coming in, because the electorate is not going to support a negative economy for that long. And so we said, and by then, this gives them a couple of years to kind of start fixing the economy. So 2020 seemed like a reasonable time frame for us. And we're going to just invest in those companies that in 5 years we know we're going to be there. They're going to be market share leaders. They better have these great brands. They better not have debt, because debt is a real problem when your interest rates are going up. And importantly, by the end of this time period, they should actually be in a better shape than they were when we invested in them. Why? Because the competition's going to suffer. And so having this longer term perspective combined with the business franchise, we thought we used what we call the upside analysis. That was a key point. And again, in 5 years, where do we see earnings in a normal scenario? And where do we see those valuations? And again, we'll talk about how that works in a specific example when we talk about a Brazilian company. And so that's how we invested in Brazil. We took the macro risk, but we are doing it in a very kind of general way. We weren't making predictions. We are making predictions about the company, not the country. And so this is what has happened thus far in 2016. 2016, you can see, again, in the non-Brazilian countries, the ones that have a higher reliance on commodities than Brazil, you can see, again, not great, but okay economic numbers. And you can see Brazil is expected to post another loss at about 38% or decline in GDP. Weighted average, that would bring you down to about negative 0.6 for this year. The majority of this is already in the bank and has happened. And you can see how compared to other economies, that Latin America is actually doing okay. What happens in the market? Well, the market booms. So nothing fundamental has really changed, but what's happened is investor perception has begun to change. And so what you see is, you can see the market, and you can see Brazil. It's up 62% this year. So it's the best performing region in the world. And and the currency appreciation, by the way, remember we had a depreciation of 86% of the return in 2015 and 2016. It's about 78% of the negative return is currency. This has come back not on currency appreciation. Currency appreciation only makes up about 20% or 25% of the value going back up. And so what that means is we still have currencies that are very cheap compared to where they used to be. And so let's look to see what this all looks like on a longer term basis on a diagram. This is the Great Recession over there. Latin America goes down more than any other region of the world. It goes down 68%. And then it comes back zooming. Why? Because what happened was that people are expecting them to do horrible. Why? Because in their mind, Latin America is an over-indebted part of the world, which it's not. Actually, Latin America has very low government debt now, and it has very low corporate debt. When you think about Latin America and large deficits and debt on the economic side, that's the Latin America of the 1970s. That's not the Latin America of the 2000s. But we think they were being treated like that, that in a weak economic environment, the Latin American economies were going to suffer the most, and they actually didn't. And when people started seeing those numbers come through that were okay, you had a very big run-up, almost reach the levels of where we were before the decline. But what happened? Largely because of currency, the market starts coming down. And why? Because the China slowdown starts to happen. And people said, China slowdown, lower commodity prices. This is going to be very negative for Latin America. And again, it was a negative, but it is not the driver. And so, and then this is when really that part of the equation got very negative, along with Brazil. Brazil, which makes up about half the index, started worrying people, and you have this huge decline here. So this is here about a year and a half. In a year and a half, you go down 56%, not that far away from times of the Great Recession when people thought, wow, we could be going into a global depression. Latin America suffers something that's similar to that point. And then what happens? Starts to come back. It bottoms out in the beginning of January, in the third week of January is where it bottoms out. What do we think starts happening? At this time, certainly no one was thinking that Dilma was going to be kicked out of government at that time. Okay, so this is all about China. What you saw is people, instead of talking about the hard landing in China, because the Chinese economy had started to slow down, is actually stopped talking about it. That's all that happened. They stopped talking about it. That's a negative factor dissipating. And when they start not thinking that commodity prices are going to go down even further, what you see is the market starts to come back. Has a little blurb here. And then what happens in Brazil? It looks like Dilma could be impeached. And that process begins. It's a very unpredictable process, but the potential of it happening started coming to fruition, and then it starts happening. And so between those two factors, we've had this big run-up in Latin America. Now, one of the questions we get asked is, did we miss it? Latin America's up 33% this year. Did we miss it? Here's how I would answer this. And it says, we're still 35% down from where we were 2 years ago. Okay, this is a technical answer. We'll have the fundamental answer later, but just technically you can see we're far down. Now, what has the other markets of the world done? I can tell you what the US market done. The S&P 500 right now is above where it was before the Great Recession. Okay, it's broken through its peak. Where are we? We're 50% down from where we were at our peak previous to the Great Recession. And I can assure you for Latin America, we did not have a bubble. previous to our peak. We did not have a lending boom. We did not have a housing bubble in Latin America. Indeed, none of our banks, major banks, went under Latin America, and the government didn't have to support those banks. And so, technically speaking, we're still very low. Let's look at what our track record looks like during these times. And so you can see in 2016, we have a big bounce back, much bigger than the market does. And that's all from the work we did in 2015. In 2015, you can see that we went down more than the market. In a negative environment, we went down more than the market. Why? Because the market was going down dramatically, and we were selling winners, those companies that people said were going to be defensive, and they were initially for us, so we sold them, and we bought into these things that the market didn't like. Now, we don't know when that decline happens or stops, okay? And so when we bought these companies and they went down more, we bought more of them. And so we're buying into the things that the market says, these are not where you want to be. And so that's why we go down more than the market in this year. And you can see this year, though, this is what happens if you buy things that the market has overly discounted. Sentiment changes, and those companies can change quite a bit, and that's what's happened thus far. And so, again, we kind of think of these two together, and now we're kind of reaping the rewards of what we did, what I think were difficult decisions in 2015. Now, I want to bring up two other points because there's maybe a recurring theme here. If you look in 2008, you can see we're down more than the market. And you can see what happens the next year in 2009. We come back stronger than the market. 2011, another big decline. Again, we underperformed pretty significantly. Why? We were doing exact same things we did last year. The following year, again, we beat out the market. So now, is this a strategy? No, it's not a strategy. We wish we didn't have to go through these declines, okay? That is set up by global markets, not by us. We react to global markets and the pricing that they offer us. I can tell you, having invested much longer than this time period, there used to be a time when buying the underappreciated stocks, the overly discounted stocks, was a defensive mechanism, and that is they would go down less in a crisis scenario. And that's traditional value investments. But this anomaly is something that we've been seeing, at least in this millennium, and that is that actually value doesn't tend to be a place for refuge. Now, I've heard some people say that if value worked the same way every time, it wouldn't be value. You have to expect it to give you tricks and behave differently in different times, and that's what makes being someone who uses that strategy difficult, but you got to stick to your discipline. Okay, so here's the way we look at what we do, and that is EPS change locally. That's what we can predict. And you can see right there, 8%, not very good. Now remember, what this is companies that were in the beginning, at the end of the time period for the whole year. So if we sold something, i.e. winners during this year, those earnings would have been above average because those sort of most defensive companies are taken out of here. But in 2015, earnings went up 8% on a local basis. That's what we can control. That's what we can kind of get those companies that we think in local currency are going to do well, because we can't control the shift into those dollar earnings. We do not know what currency is going to do. We don't think anyone does, but we know for sure we don't know what a currency is going to do. And so 8% gets turned into dollars to negative 15%. And then you can look to see what the market does with that, and they mark it down. There's a 22 percentage point differential there. In 2014, a similar thing happened, and you have another big differential there of 21 percentage points. And what happens when earnings go down, but the prices go down even more, what happens is you get better valuations. You get better bargains available to you, and that's what we try to react to. This is our portfolio. You may recall, Brazil is the best performing market in 2016. We were looking for opportunities, and we found some in Brazil, but we didn't find as many as we liked. Remember, Brazil brought down the other markets also, okay? And so we were finding other opportunities in places that other investors who are maybe not, or at least according to the index, were not looking at as much. And so we were underweighted in Brazil, but that didn't stop the certain companies that we invested of appreciating very well in spite of the fact that they weren't in Brazil. So to this day, we remain what you would consider a significant underweighting under Brazil. My point is that what matters to us is stocks, not countries. And we don't look at this. We don't formulate our portfolio based on that. That's an end result of our bottom-up work. And this is the portfolio. And so, now getting to your question, I know this is a little bit difficult to see, but right here, you can look at, or you can look to see what valuations are. And so, if you had really low earnings going forward, or in 2016, which remember, we're basically almost there. We certainly have 2 quarters already in the bag, and then we have maybe a quarter of projections. But what I'm saying here is that the earnings and what we're paying for it is 13.2 times. And so what I'm saying is that there is value there for those earnings that we're getting to. And these are on depressed earnings. Why do I say that? Let's look at a company, Cemex. Cemex is a company that's just going to finally turn a little bit of earnings. It's at a 19.3. That's a growth valuation of our opinion. And so that's not what Cemex is. No one is buying Cemex because it's a growth company. Everyone is buying it because they think that finally they have their debt situation under control. The earnings are not that much. So we would argue that that's a really high PE for that company. And so 13.2 is the valuation. Latin America, at the end of the day, works, we think, like other global parts of the world. Fundamentals are the same around the world and how they ultimately get treated. And that is, if you look at the long-term average of PEs around the world, on a historical average, it's about 17 times. So we think that's significantly below that, and again, that would be on depressed earnings. Okay, so we think this is the proof that you're buying earnings cheaply right now in Latin America, particularly when you have them discounted the way, or I should say undervalued, that they're not in a normalized scenario yet. The other thing to note is 2% dividend yield. Having done this for a very long time, generally Latin America gives you dividend yield of less than 1%. Why would that be? Because they have growth opportunity, so companies want to reinvest instead of paying dividends. And 2, debt is expensive in Latin America. So what you do with your internal cash flows, you keep it. And so you hardly pay out any in dividends. When you get 2%, that's 2 times the average dividend yield that you get in Latin America. You're looking at low valuations. So this is our whole portfolio, and to us, and you can see some of the appreciation levels that we have here, and yet in spite of some of these appreciations, remember what I said, it allows you to have a longer holding period. We don't think that we have valuations on these companies that make them now want to be taken out of the portfolio. We still think that in spite of these appreciations, we have very good valuation levels. So now I'm going to talk about our long-term views of Latin America. They're very general. We believe that Mexico, Peru, Colombia, and Chile are in good shape. These are economies that are very well managed. Inflation is very low. And we think that in spite of what has been happening with the commodity prices, in spite of what can happen, and you see commodity prices are already very low, the effect of these countries has largely happened, but we think fundamentally they're in very good shape. Brazil and Argentina are 2 companies that went through crisis. Both of them hit double-digit fiscal deficits. And so both of them are improving, but it is a difficult road to keep following and to continue implementing what they're doing, especially because they have to cut costs. They cannot raise taxes. Brazil has one of the largest GDP taxes per GDP in the world. It's about 34%. It is a highly taxed economy. They know they can't raise taxes. They're going to have to cut spending. Not easy to do. Will take time. They're doing a very good job right now. But again, it takes a long time for these major macro trends to come to fruition. Argentina in a similar situation. This, though, now we would think is something very important, in that there's been a huge decline in populist policy. So in Argentina, you have a new pro-reform, And then you have government in Brazil, the same thing. In Chile, you have a populist in power, Bachelet, who has about approval ratings of about 20%. We feel pretty confident that the elections next year, you're going to get a more business-oriented, growth-oriented government in Chile. Venezuela, I think you guys know, it's the biggest economic disaster in the world right now. It's just the government, through its control of the judicial system, is being able to stay in power, but it's just a function of time before they go out. And there's two other countries here, Mexico and Peru. Peru had a leftist president, Humala, who recently went out of office. His term ended. Humala was certainly a populist leftist, but he was actually very pragmatic. And then who we have now, Pedro Pablo Kuczynski, a guy who used to run the Latin American Enterprise Fund. He's a private equity guy, used to have his offices in Miami, now he's the president of Peru. Obviously, this guy's going to be kind of a pro-business, pro-growth type president, depending how effective he will be, depending on how much Congress is able to support him. And in Mexico, while it's a mixed bag on Peña Nieto, one thing you can say is that the PRI is the bastion of populism, the PRI party in Mexico. He at least did pass through some reforms that we think are very important. They're long-term reforms. They'll have a good benefit to them. But the important thing is that the PRI is not the populist party of the past. And so what we're saying here is that the electorate in Latin America is voting with their wallet. And that's very important. And the way they notice it is in inflation numbers. And that's, if there was one single number to look at in Latin America to track economies, it's inflation. And that is pretty much down low, except for a few countries which are moving in the right direction now. We expect consumption growth to continue. Latin America has very low metrics of consumption, whereas the cars or how much retailers you have per square meter. And it has very favorable demographics, the youngest region in the world except for Africa. So you have a group of people that are going into their consumption years, and you have what you need for consumption is low inflation, and we have that in Latin America. And so we expect this consumption growth to be a secular long-term positive for Latin America. And so we expect that also Latin American currencies will strengthen. Okay, that's a macro bet, we realize, and it's a very general bet, and so we'll talk a little bit about why we think that. So this is average inflation. Again, remember what I was talking about? You need stable inflation. Look, those are pretty good inflation numbers. These are pretty good, and then the one that's problematic is Brazil. And so Brazil's at about 7%. You can see it got 10.7%. It's going to start heading down. So that's an improvement. But overall in these countries, you have very low inflation. If you combine this with the Brazilian one, there's your weighted average inflation number for Latin America. Here's the US inflation number. Long-term currencies, if you believe the theory, and I do, over long-term currencies just makes up for the difference in inflation. Okay, so if you look at this differential, 3.8% for the last 5 years. But look at what currencies depreciation on 12.3%. So you have about an 8% differential there in currencies per year. You compound that, it's really significant. Okay, now, not the most scientific analysis in the world, Big Mac index, but you can see one, it's telling you United States, pretty strong currency right now. Actually, Brazil's a little bit lower. In spite of the fact that it's gone through the biggest evaluation than any other country, Brazil's actually the currency not as cheap as one would think, because it came up from such a high level. But what you do see here are the other Latin American countries, and there's Mexico, very close to the bottom. Very cheap currency, about 20 pesos to the dollar. So when people ask us, because they know we know a bit about Latin America, where they say should vacation, where they're going to get the most bang for their buck, I tell them go to the Maya Riviera. It's safe, you get a lot of bang for your buck, world-class service. So this is really what it's telling you here. And so we think there's room for the currency side. Having said that, what we do believe for sure is that the currency depreciation that you've seen in the past, that's been the largest driver of Latin America underperforming, that's not going to continue. We don't think that's sustainable. So what are we doing in 2016? Kind of the same things we've always done. We're allowing those bets that we think are still undervalued to develop. We picked up a lot of them in 2015, so we're not having to make as many portfolio decisions this year. And we're shifting our allocation from those that have done the best to those that haven't done as well. moving it to the lower valuations. We are looking for company bargains again, where underperforming countries, Mexico is down 2% this year. Chile has underperformed. Chile used to be a country we would hardly even look at because the valuations were so high. It's done so badly lately that it's actually, we think, maybe a pocket of value. Argentina did very well. We sold out because we thought it was largely priced in the favorable prospects, and now we have thinking that maybe there's an opportunity there again. It's a little bit good that you're going to have to depend for some growth to be out Argentina. And we're looking at sectors that are out of favor. The banking sector, as you all know, right now, banks are out of favor on a global basis. And what are global traders telling you? Banks, you shouldn't be in there. It manifests itself in Latin America. We think there's a great opportunity in banks. And as always, we're looking for companies that are out of favor. And so that's what we're doing with the portfolio. That really wraps up what I was going to say